All
Nicely
right. Well,
done.
John Donlon, Gold Coast Mortgage, thanks for joining us on Financially Mindful.
Yeah, pleasure to be here. Thanks for inviting me. Honored.
Yeah, I'm excited to talk to you, especially right now. It's been a wild year, to say the least. And as I look back at some of the big stories, one of the biggest, obviously, is the economy and interest rates and the actions of the Fed. And as a downstream result of that, the impact that it's had to date on the mortgage industry and real estate in general has been a big story. So I'm
Mm,
excited to talk to you today. And maybe to kind of kick us off in the conversation, do you have any thoughts or comments? How did we get here? The middle of part of December 2022, as this is being recorded, the
yeah.
beginning part of the year, people were refinancing at close to historically low
Right.
rates, and now we're at roughly 6%. So, what's your thoughts and takeaways from 2022 so far?
Yeah. So we've been really spoiled with interest rates for a long time. The Federal Reserve has had quantitative easing at play for as long as I can remember. Um, so if interest rates are a pendulum, they've been magnetized to one side very aggressively and pinned at that low rate. But it was done artificially. It was funds from the Federal Reserve that were just printing money to buy the bonds to manipulate the interest rate. And so prior to quantitative easing, mortgage interest rates always did their own thing. They were subject to like free market environment. Quantitative easing came in and it kind of cornered that market. So we got the benefit of these low rates. I didn't necessarily agree with it, but I was the direct beneficiary of it because my
Mm-hmm.
industry did really well. Homeowners got sale on their interest rate for a long time.
Mm-hmm.
And when quantitative easing ended, it was winding down, the bonds were stopped being purchased. The magnetism on the pendulum released, and that pendulum very quickly went back to not to the middle, but it came back into alignment where it was detached from the artificial influence. So we went from 3 to 6 in very short order.
Mm-hmm.
And in June, they were expecting to engage in quantitative tightening. So that would have taken the pendulum the other way. So the market has to do its own thing on rates, and then there is potential for the pendulum to swing really hard the other way as we go into the quantitative tightening environment. Nobody knows what that's going to look like. We've never had quantitative easing before this last period of time, and we've never really had quantitative tightening. So the effect on real estate and mortgages, it's really to be determined. We don't have anything to compare it to. There's no real case study on it.
Mm-hmm.
Do you think to that end, I mean, as you say, the quant easing really is a response to 2008 and that downturn.
Yeah, it
So,
was. Yeah,
right. So do
right.
you think, so the conditions are different, but I guess the question is, do you think the doubling effectively of mortgage rates and the impact that's going to have on folks who are due to renew and the housing market generally will have a similar impact to what was experienced in 2008? Or do you think that the landing will be softer?
So there's an additional 10 or more issues that we have now that we didn't have through 2008. The issues in 2008 with subprime, those may not be a part of the process this time, but so the script is different, but there's striking similarities to what's going on now to 2008. So we had the word subprime, which has been retired, but it was replaced with a term called non-qualified mortgage, non-QM. So anything that was Dodd-Frank tried to eliminate with clean, concise, really accurate mortgage applications, anything that was outside of Dodd-Frank was a non-qualified mortgage. So Dodd-Frank's put this umbrella on qualified mortgages, and the non-qualified mortgages were anything outside of that. So subprime went away, but non-QM, that's kind of the street name, that came up in mass. It just was absolutely everywhere for the past few years. Non-QM, I got 100 solicitations a day from non-QM lenders looking for business. We didn't get into that lane, just like we didn't get into the subprime lane, but non-QM was really prevalent. In addition to that, we had adjustable rate mortgages came back on the scene as a workaround to the spike up in interest rates. So more
You're talking about recently?
recently, yeah. So
yeah.
ARM mortgages came out of nowhere. That was a huge, let's say, workaround to try to beat the higher fixed rate interest rates. And so I look at those as an issue.
And for those listening, what an ARM, if you don't know, what is an ARM mortgage?
So yeah, it's an adjustable rate mortgage, and it's tied to what could be an overseas index, right? So sometimes we used to hear about like the LIBOR, a London rate. So we've got these really obscure indexes which drive it. The rate adjustments are not based on the future rate adjustments are not based upon where mortgage rates are at the time. They're based on where these indexes are at that time. And then there's a spring-loaded feature on the adjustable rate mortgages above the index, and that's called the margin. And so the margin provides like the jack-in-the-box spring when the rate resets. And I recently wrote a piece on how modern ARMs work, and they can achieve the full cap on that spring-loaded feature. In the first month, they're allowed to adjust. So payment 37, payment 61, payment 73. They can hit the full 6% cap can be achieved in one adjustment period. So the rate could go from 3 to 9 on the first time that they let the leash off it. So go ahead, Jim.
Go ahead, John. Finish up your answer.
Yeah. So just last thought on that is there's a lot of consumers who are in ARMs that don't really understand how they work. They're not subprime, but at some point, the tail on that dragon could come back around, and it could have an effect on tens of thousands, hundreds of thousands of consumers, among other things.
So we're a little bit delayed here from really seeing the true impact of this spike in interest rates. It's possible in 6 or 12 months you're going to see the flow through of that increase in mortgage payments for the broader housing market, or what is that time frame?
Right. It's so we're looking at like a Swiss watch with the back off of it, and there's a lot of gears ticking and turning. And the Federal Reserve put a little needle in there, played with it. The adjustable rates played with it. Non-QM played with it. All these factors, COVID. And so the watch has its own how it's running is like nothing we've seen before. And so I can't predict when or how it's all going to manifest in the future. But everything does have to unfold and be played out. So, yeah.
How does that impact? Sorry, Jim, do you have a question?
Oh, well, I was just, from the question that I have is, let me back up and pause because I'm choking on my words here. You mentioned timing, Dan, and kind of where do we go from here? And I appreciate your perspective, John, that we can't predict the future. And I think that's important for a lot of people to keep in mind as we navigate this conversation. We don't know what's going to happen moving forward. But as I look at historical rates, historical home values, real estate and mortgages, as I see it, tend to be a lot more long-term cyclical than even say the market. I think people are familiar with the market going up and down, but the long-term trend has been up, historically speaking. With mortgage rates, it's that pendulum that you mentioned before. It's long swings of this pendulum. So should we expect that with the Fed no longer intervening, that pendulum naturally wants to probably swing a little further north than where rates are right now?
I believe so. I think a natural pendulum could be at 7 or 8%. And with quantitative tightening, it could push it towards double digits. So we may be losing a sub 4% rate for decades. It may not come back on the scene, and if it does come back on the scene, we may have to be careful what we wish for, because that could mean that there's further
Economic.
involvement, right?
Yeah.
That something's going on in the world where they have to put their hand back in it. So the natural rate, who knows really where it is? I've looked at a graph of like the prime lending rate over the years, and it's very comfortable as a double-digit rate. It tends to spend a fair amount of time as a double-digit rate.
Yeah.
We've gotten very used to single digits and
And
spoiled by it.
It's dissimilar. I think a lot of people, they think, oh, well, rates spiked. My mortgage payment potentially goes up if I'm a buyer. The market's, moving through a period of volatility, but it'll settle out. We get through these recessions and cycles and we move on. But again, it's not a half a step backward and then we continue to march forward. If you think about a rate on a graph, it's long-term spikes and troughs. And the trough that we were in, say, a few months ago, the prior high was 1981.
Yeah.
So that was the year I was born. So,
right.
Are we on a long march back cyclically? Obviously, there's a lot different, but I guess, do you agree with my thought that people should temper their expectations that this is going to be a short-term blip in
Right.
rates?
Yeah. Right. There's if this becomes a short-term blip, that means things have gone really chaotic in the markets, right? For them to come back in and push the rates back down, that would contradict everything that we're being told right now about the Fed Reserve trying to tame inflation. It would be contrary to everything that's published. So, and it would be ugly if they went back in and tried to push the rates down.
So for those people now who maybe are considering buying a house or wanted to buy a house within the next 12 to 18 months, what are the implications for them in terms of affordability and the availability of loans?
Yeah. So there's probably a few psychological issues, right? One, we'll have to get used to rates being at 6, 7, 8, 9. And that's going to take some time for that to kind of wash over the marketplace. People are then the other psychological issue is that unless you're a first-time home buyer, you have a house that's anchored with a rate that starts with a 2 or a 3. And in order to give that up and then come back in the game at a 6 or 7, it's going to really have to be a compelling reason for you to sell, get rid of your 3%, cash it in, and accept a 6 or 7%. Now, the forces that are causing you to upgrade residences, they'll have to be compelling enough to endure the pain of giving up the low rate. So it won't be a lateral move. And so over the past few years, we've had folks that are upgrading for minor reasons, like a slightly better kitchen, a better lot, a little more parking, extra bedroom. That's not going to happen. So they're going to stay put. They're going to keep the 3%. They're going to dormer their second floor. They're going to redo their kitchen instead of buying a house with a better kitchen. They're going to stay put. So the market is going to get locked up. And the other thing is, when rates are up at this point, there may be a mental correlation between higher interest rates equaling lower real estate prices. Now, that's not a law, but I think people are beginning to expect, if my mortgage payment is going to be more, I want a discount on the price of the future home. So they're going to pay more for the money, but they want a sale price. So they're waiting for the sale. So we see it locked up a little bit. So it could be a little self-fulfilling that people are stuck. They don't necessarily want to move. Now, first-time home buyer, if the payment works for them on the new home, this is probably a great time to enter into the market, because they're not entering into like the frothy, highly competitive, overbidding, chaotic auction type of environment that we were just getting out of. We spent the last 30 months in this like frenzied bidding war cycle.
And can you talk about that change, John? How long did that take this year? Are you just starting to see that start to slow down now, or has it kind of been a slow build as rates have raised throughout the year?
Yeah. So So I'm seeing benefits in all negotiable areas of a purchase. So the terms of the purchase are getting better, such as last year you were expected to waive your home inspection commitment, that you'd buy the house, but not with a home inspection. They wouldn't allow it if you're going to be considered a serious offer. They say waive your home inspection. Prior to COVID, that was literally like a suicidal process to go and buy a home without an inspection, but it became the norm. It became the norm during COVID. Emotionally charged, panic-driven buyers and sellers having the ability to say, nope, we're not allowing it. So the home inspection is back. Thank goodness, it's back.
Yeah.
Yep. Among other good attributes that,
that
you can,
that point coupled with just in general some of that hysteria being teased out of the market, if you will, from the rise in rates, that's a net positive for somebody that's especially a first-time home buyer who's never gone through that process before, to be able to catch their breath a little bit when they're evaluating what could be their biggest financial decision ever.
Huge, right? Quantifiable benefit in every way you look at it. So overbidding has ended. The ability to negotiate on certain physical attributes in the house, that's back. Home inspection is back. Mortgage financing contingency is back. All the protections that a homeowner, future homeowner deserves, he's got them back. And I love it. It's good.
That's great.
Yeah. Yeah.
To that end, I mean, it's interesting because I was just looking at rates when you first started your business back in 99, 2000, and they were up around 8-9%.
Right.
Right.
Yep.
And so you've obviously, this is the second super cycle, I guess, you've seen with peaks in the trough. How does this market compare to what you saw 20, 25 years ago when you were first getting out in this business?
Yeah. So I think it's coming back to basics a little bit, and we're looking at, does the payment work for the incomes in the household, for the lifestyle? And so somebody that's stepping onto the stage for the first time to buy a house, they want to make sure that it's affordable. And so the rate kind of takes the back seat, and the payment becomes the primary concern. And if the payment light is green, then the transaction becomes almost a no-brainer. You got to live somewhere. You'd rather own than pitching money out the window to a landlord, and subjecting yourself to steady rental increases every year, with no privacy and really hard to maintain like pets and start a family in a rental community, right? So if the payment works, stepping into the game at this point is extremely logical. It's a good, fair playing field. You can negotiate, and you're not forced into a transaction.
It's interesting you mentioned, to your point, that psychological adjustment of going from like 2 to 3% to 8 to 10%. I kind of, as you were saying that, I almost feel about, it's almost like, and this may be more true in the UK where there's more private schools, but sometimes, people move to where there's a good school. And either you pay for the school and you pay the fees, and that can be tens of thousands of dollars a year, or you pay for the school through the property price, where because there's a good public school, you don't pay the fee. But, do you think that's the same kind of thing here, where there'll be an adjustment? And what we've seen over the last 5 to 7 years is that while rates are low, essentially you're paying for that value in the inflated price of the house. But now that equation is going to change. So you may pay more mortgage, more principal and interest, but the price of the house will be lower. So fundamentally, that it's just, you're going to pay, as you said, you're going to pay less for the house. You're just going to pay more interest, essentially. Yeah. Is that how people should begin to think about it?
Yeah, well, the one thing that's not subject to inflation is your mortgage payment. So you lock it in today's dollars, and as things around you move up or down, let's say incomes go up over time and the cost of the real estate goes up over time, the mortgage payment is static for the life of home ownership. An example I remember from my youth was I happened to be at my aunt's house the day she had paid off her mortgage. was kind of incredible. So it just happened to be I was there, and they opened. They said, "Well, the mortgage is done." It was like a moment of celebration. Now they lived in an incredible house. I was like, it was a old federal home on Chestnut Street in Salem. It was a ship's captain's mansion. And so I said to her, maybe I was 10 years old. I said, "How much was your mortgage payment?" And she said, it was like $490. I go, "How's that possible?" And she said, "John, we took this mortgage out 30 years ago. And when my uncle was starting his business at that time," she said, "that was a huge amount of money for us. We didn't know if we were going to be able to afford it. But over time, that mortgage payment it went down because everything else was going up in price." And so the real estate that if you own it long enough, you can add a zero to the value. And that's probably every 35 to 40 years, you get your zero. And that's if you hold it long enough. So I remember like my parents bought their house the year I was born for $30,000. They sold it 30 years later for $300,000. And if you went back 30 years before I was born, that house was selling for around $5,000. So you get an approximate zero every 30 or 35 years just due to a relatively normal rate of appreciation. So if you get in now and the payment works and you do lock your rate in, a rate of 6, 7, or 8 or 9% even can really work for you, and you've leveraged that asset 80%, right? 4/5 of the money of it's coming from somebody else at a fixed rate. You get the full appreciation over time.
I think something you're touching on, which I think is so important, which I often think is true of lots of things, like when you boil it down like that, if you take this idea, as you say, like what can you afford to pay, and then do you think about it over a significant enough long period of time? So I think for most people, they assume they're going to live in a place for 5 to 10 years at least, but often longer. And so when you start looking at the longer term view and you say, okay, yeah, the sticker shock of an 8% or 6% rate is greater than 6 months ago when it was 3 or 4. But as you say, that's fixed, and you've got that certainty of payment. As long as you can afford it or it's comfortable enough, then you take that longer term view, you should be okay.
Yeah, and just to add to that, and kind of summarize some of the points we've been hearing from you, John, the last few minutes, I think it's a great example, Dan, of just kind of separating yourself from the noise and the kind of the hysteria of the decision, if you will. So I guess, what I mean by that, if, a lot of the chaos of the buying has gone away because rates have gone up and we're back to basics, and there's a lot of positives in the buying process now for the buyer. Don't get too wrapped up in the headlines of how bad it is that rates have gone up so significantly. It's actually a nice time to catch your breath and actually enjoy the home buying experience, and maybe look for the actual place that you can envision yourself in for 30 years. You kind of had to hurry up and have that discussion with yourself or your partner or whomever in a really condensed period of time, because once something was listed, on Friday, if you weren't there Saturday, it was gone by Sunday. And a lot of, what we started the conversation with, a little bit of doom and gloom and how shocking it was that rates have gone up. It's kind of a nice result for the first time home buyer, that it does free up a little bit of time, even though, it might feel like it's more than it was a couple of months ago. As long as it's affordable, I think that's a great advice and a place to start your conversation.
I like that. And, we're concerned with how does the mortgage payment compare to the average rental payment too, right? And so rental payments have gone up significantly. And if you can transfer into home ownership and the payment is somewhat equal, but it is locked in, right? Where the rents aren't locked. They're subject to, let's say, an apartment community is sold to an investment fund on Wall Street. The first thing they do is come in and they torque up the rent prices for the whole community because they want the asset to perform a little better. So that's not how good you are as a tenant. That's basically who bought the rental portfolio that you're kind of contributing to the return on. So I like to take a look at like comparison for quality of life purposes. What does this mortgage payment get you? and
Mm-hmm.
it's probably going to get you a lot further now without the competitive aspect of trying to acquire a home.
Mm-hmm.
When you're buying based on emotion, that's where mistakes are made, and that's where the overlooked home inspection can swing back and get you
Yeah.
later when you find out that, yeah, there's
Well,
issues with the house.
and as far as rent versus owning, I, I haven't looked at those numbers specifically very recently, but it's a pretty significant increase in average rents here to go along with inflation of everything else. So yes, mortgage interest rates have gone up, and yes, that home that you might be looking at as a first time home buyer is more expensive. But how much did your rent go up last year, and how much could it continue to go up over time as compared to a
Yeah,
fixed payment at a higher rate right now?
right.
So
Yeah.
definitely great food for thought.
Mm.
In this market, John, as the rate environment changes, um, does your process of evaluation when thinking about mortgage origination change? How do you adjust when you mentioned a couple of things? The home inspection obviously now is becoming the norm, but are there things that you look for that have changed, and how should our listeners be thinking about that process of applying for a mortgage? Like, how can they prepare better than 6 months ago, where it probably, I'm guessing, would have been slightly easier than it is
Yeah.
today?
So I'd say one of the biggest mistakes somebody can make would be buying the wrong home at the wrong time. And they may not know it's the wrong time if they buy the home, but they find out that their employer now has to reduce a workforce or reduce expense and cuts wages. So striking extremely carefully on the home, deliberately, not just out of emotion, but planning a process, taking the time to do it. I think that's critical. So you wouldn't want to buy a home at this point in history, have home values recede a little bit, lose your job, be forced into a sale when now you're underwater on the house. Uh, so I'd say purchase strategically, purchase deliberately, uh, purchase with a timeline that will allow you to wait out any retreats in the values, so that if you're on a longer timeline, you can handle a small real estate recession. You're not forced to sell. But if you're on a 3-year timeline, you could get pinned in with equity. Like, your down payment could erode pretty quickly, and if you're forced to sell, you're walking away with nothing, or you're even short on the value. That's something you want to consider real carefully. So to answer your question, Dan, I think the timeline's the biggest factor, and then really critically evaluating your employment structure to make sure you're on solid footing there before you
Mm.
swing.
And in terms
Yeah.
of, values going down or interest rates continuing to go up, I think some people, we've been spoiled, myself included at times, to expect that, well, I can always refinance or the value is going to continue to go up, right? And over the long term, maybe at least the value part of that equation might be true. But I just want to reiterate and hear your thoughts. It's not impossible for rates to continue to go up, and it's not impossible. And in fact, historically speaking, property values will probably come down in the short term. And I just think that that's worth mentioning again and reiterating. Um, our past experience since 2008 has been somewhat artificial, and now we're
Mm,
going back to the what used to be normal.
right. So the influence has been removed. It's a free market condition. It's where you want to be. You want the markets to do their thing. Um, and they're going to do their thing. What it is, we don't know, right? But um, so yeah, I agree with you, Jim. And there are a lot of reasons that your ability to refinance in the future may not be available to you. So in 2008 and 2009, refinancing, it became really restrictive because there was a loss of equity. The products that you wanted to get into were no longer available. You went to hop over to a refinance mortgage, and the product offering was let's say it wasn't there because jumbo mortgages were non-available for a period of time, right? And so yeah, there's a few reasons why you can't say with certainty you'll be able to refinance. You hope you'll be able to if the circumstances better your household. You go for it, but it's not always a guarantee that you can get access to money in the future when you need it.
I think you touched on something really important as well, John, which is for people to think about their finances beyond the mortgage. So as you say, whether that's your current employment situation, but not overstretching yourself even with a down payment and using all your savings so that you have a cash reserve so that if you don't have a job for 6 to 12 months or there is some unforeseen expenditure with a house, you can afford to cover that cost or you can afford to cover the mortgage for a period of time. And really thinking about it holistically, not just here's what we can afford, assuming everything stays the same, right?
Those are really important considerations, and now that we can exhale a little bit, focus on the logic of the transaction as opposed to the emotion of the transaction, I think we're going to make better decisions. So there was a lot of really emotionally charged transactions that occurred, and even when we were in it, we're shaking our head, going, "No, this is you're reaching too far. You're overbidding with somebody else's money," and that's. But people were fearful. They wanted to depart the city. They wanted to get into the suburbs. They wanted to have space where two people could work from home as opposed to being, crowded in a Boston condo. And so there was a lot of fear and emotion behind everything. That's subsided.
Do you also think there was some greed and enthusiasm at the same time, kind of coupled with that, yeah, I'm borrowing more money to get into this neighborhood or the suburbs or the mountains, but it's 2.75%. I'd be stupid not to borrow that money on this particular transaction. It was almost like was it both things at once, kind of somehow mashed together?
Yeah, I'd be lying if I said I didn't see a fair amount of greed, during this process. It was the sellers on that side, and certainly people reaching or stretching. But I do think the clock of life was ticking a little bit louder during the pandemic. So people were justifying, say, I deserve this. Maybe they had a close touch with, maybe something happened from the pandemic that they saw came close to home. So they're like, okay, we're going to do this. And it's the right time. And we didn't know where the world was going at that point, right? It was, we were washing out groceries and fearful of everything. So
it's really interesting because I think, to your point, that's the other driver, isn't it? Especially in the UK, but in the areas outside of New York and outside of the big cities in California, the desire for more space because people are working from home has driven demand for single family houses, isn't it? And that is another driver of upward pressure on prices. And so the question is, as companies move back to the office, as people just want to be closer because they don't want to commute because they're going to have to go to the office, what is there actually, as you say, is that going to partially offset some of that locked up market? I think it's interesting to see how that will pan out. But I'd love your thoughts on that.
Yeah, so just preface this that I have a minor in economics from a state school, so I'm really not qualified to make any predictions, okay? And most of my predictions are wrong, okay? So Jim knows I've made some predictions. They're just wrong. So over 50% of my predictions are wrong. So I wouldn't put too much weight in what I'm about to say. However, I do know that there's a fair amount of people who put their finger on a map and said, I'm going to buy a house there. And they put their finger on Vermont, Maine, New Hampshire, because they had a fond memory from their childhood of going to a clear, cold lake when they were kids with their family. And the shackles came off of employment, and they said, I can live there. It's got Wi-Fi, and we're moving. And so that finger dropped on a map tens of thousands of times, if not more. And Vermont, New Hampshire, Maine put up the biggest numbers we've ever seen in our lifetime for volume and for price paid. And then they wind up in those areas, and the winters are a little colder than they thought they would be. their employer, because they're in tech, maybe went through a downsize and their next available job is no longer fully remote. So some of those homes are going to be turned back into the market, probably as quickly as they populated. And the ones going back on the market, now the jagged edge, that waived home inspection, is now visible. It's not going to be waived this round. So the equity in, there's going to be a loss of equity in those homes, even just buying and selling. If the price remains the same, there's administrative costs for liquidating your home, right? There's sales commissions, there's tax stamps, there's closing costs, there's a lot, list goes on, right? So all things equal, you buy a house for $100 and you sell it for $100, you're going to lose $10 just in administrative fees. Never mind the fact that, okay, the old boiler or the asbestos shingles or the aluminum wiring, all those now have to be fixed at the seller's expense, because the new home buyer is going to be in a very civilized buying process, right? So, yeah, so to answer your question, yes, that my prediction is that some of those homes that were bought in haste are going to come back in as somewhat damaged goods, and they'll have to take a certain percent off the price to get them to move, and they'll be in a flock of inventory where there wasn't a glut of homes for sale in those states before, but there will be this winter.
Yeah. For your business now, given the, sorry, Jim, I was just going to ask, like, John, for your business now, how do you think about positioning yourself given the change in the risk environment and some of the conditions that obviously weren't there 6 months ago?
Yeah. So I think the only thing that is really important is consistency for me. And so this isn't the right time for me to introduce new products, experiment with things that I'm not an expert at, to get into non-QM or adjustable rates or other products. So we're going to stay in our lane. We're going to stay consistent. We're going to stay accessible, available, and then just provide the same service and quality assurance that we've had the whole time. So to be there for the problems that are going to need to be solved. There are going to be people that do need to swing. They swung over the river on the vine, and now they have to swing back. And they're going to need some assistance swinging back because their load's going to be a little heavier. So we'll have to be on standby to help them get back to where they need to be, help them with the transaction, help them unwind real estate, or help them negotiate in a new environment. And so, yeah, consistency and availability, and try to stay healthy, just be ready.
Yeah. I think that's good advice for anybody, is being in a position to help people solve problems. And there are, you mentioned before, compelling reasons for people to move and buy and sell real estate. Those things aren't going to go away. People are going to get divorced. They're going to get jobs and have to move to new areas, etc. I think there's a lot that remains to be seen as how things kind of settle out geographically related to jobs as we kind of move into the new normal post COVID. So that's probably a great place to situate yourself as a problem solver and somebody that can help navigate those waters with folks.
Mm-hmm.
Real quick, I wanted to ask you a kind of specific question. You've referenced in conversations we've had the Case-Shiller National Home Price data. And as I look at those charts, we could post it in the show notes so people could take a look. We have officially, you were kind of humble with your prediction ratio, your win-loss ratio there. But in terms of where home prices are going, the data would suggest that nationally we've kind of tipped the crescendo. We're past the tipping point now and on the other side and in the lowering mode. Am I looking at that and reading that correctly?
Yeah. So I'm absolutely fascinated with that graph. I was fascinated with it before it reached the pinnacle in reverse direction. So the graph has a 2-month lag. What we're seeing is September numbers. So I developed an interest in it over the summer. And what I've done is I've taken the movement, and the graph is based on a number, and the difference between the number month over month, the percentage of loss that we've experienced in the last 2 months. I went back through the graph all the way back into the 80s or mid 80s, and I haven't seen the same percentage downwardness, if that's a word, appear anywhere on the graph. Like I overlaid it through 2008, and the correction was not as sharp. Like the downward angle was not as sharp anywhere during 2008.
Mm-hmm.
So the chart's published the last Tuesday of the month, and you'll find me on that website ready to receive the numbers, because the velocity of that downward angle is extremely concerning to me.
And it's probably tough for the regular consumer to appreciate what's happening with property values, because Zillow, how much stock can you place in a site like Zillow, which is probably where a lot of people go, unless you really have your home appraised or in the market and really studying what a home might be sold or bought for. It's really difficult to fully appreciate what's happening with home values. And I thought that was a really interesting chart. And again, we'll share it. And these are long-term cyclical markets. And we seem to have tipped over the top of a cycle. We're not going to make any predictions of where we go from here, but just food for thought.
Right.
For the folks that are entering the market, have to purchase, want to move, to again, be deliberate, as you mentioned before, and really appreciate what you're up against.
Yeah, I had a chance to assist a former client buying a house in Arizona. This was 2 Fridays ago. So we live in a region where the houses are unique. He was buying in like a homogenized neighborhood. And so the houses were all very similar. And there was more of a market price than there is what we have here based on like curb appeal. So what he had told me is that the developer of the project was willing to offer him specifically on that Friday afternoon $30,000 off of not the price, because they wanted to maintain the price, but he's willing to invest $30,000 to buy the interest rate down for this client that I was helping, $30,000. And so I said, can you get $30,000 off the price? And he said, no, they don't want to do that, because then the whole project loses 9% of its value in one day. He said, but they're willing to mask the price reduction with the purchase of a rate that he said would put him in the 4s. And so like he's literally the developer's going to pay him $30,000 to take his rate from mid 6s to into the 4s. And I said, "This is fascinating." I told him to go for it, because like he's like like that's like getting in a time machine and going back and seizing the rate from like the first quarter of this year, second quarter. So he ended up putting the house under agreement. Now the value of the house will go down. We know that one's already headed south, but he's planning to stay there, through retirement. So
timeline works, right?
His timeline works, right? So if it lose value, it's really only on paper to him. The payment works, the house works, the commute works, the lifestyle works. He can just wait it out. If it comes down in value, go back up over time. He'll get a 0 if he waits long enough. If he lives long enough, it'll be worth $4 million.
Yeah, and that kind of gives us a good summary of what we talked about. Obviously it's shocking. We started out the conversation talking about rates going up and, some of the causes of that and some of the issues that still, it sounds like, might remain to be seen, the impact, right? There's going to be new data and things that you're studying that are going to come out that might not be good news. But if you take the time and invest the time to lay out a plan and have your timeline and it's the right place, you've got the right timeline, it feels like there's a lot of good that's come out of this this last 12 months or so, to kind of eliminate some of that froth and hysteria and chaos that was the home buying experience for a lot of people. So maybe we're ending at a net positive.
We are. I agree with that. I like that, Jim. Yep. Yeah.
Is there anything else that we missed? Any words of wisdom or takeaways that you'd want to leave with folks before we let you go as it relates to buying a home or as we look out into 2023?
Yes. So I think a deliberate, strategic acquisition is a lot better than an emotionally charged, very rushed process. So I like the process where things are less reactive and more planned. And we're entering into this stage where the luxury we didn't have of planning before is back. So really look at the decision to buy strategically for the long term, and I think people will do well if they have the luxury of that planning process on their side.
Great. Also, before we let you go, how do people find you in Gold Coast? Is there a specific place people with mortgage questions or those looking for mortgage information should check out?
Yeah. Thank you, Jim. That's wonderful. We're here for free service and guidance, and I say that that's been for a couple of decades. We've always said we'll share what we know with no detachment from having to the client work with us for their mortgage. So we'll provide service and guidance if it helps them on their real estate journey, even if it's in another state where we can't participate. We're okay with that. I'd love to help out with any considerations, and if it leads to a mortgage, I'd be honored to write it. But that's not why we pass out our guidance. Yeah, goldcoastmortgage.com. Right. That's
awesome.
Yeah.
Cool. All right. With that, then, just thank you for your time and expertise, John. I can attest to your willingness to share that information and be a resource. So I hope people reach out to you, and it's a pleasure to have you here. Thanks again.
Yeah, thank you.
And we'll have you back maybe this time next year to check one more prediction. See if we can
All right.
increase your scorecard there. All right.
Okay. All right. Thank you.
Thank you, John.
Thanks,
Take care.
You're very welcome.
All right.